What are you seeing in this early market action for 2023, and how are you telling your clients to balance their portfolios?
So what we're seeing is just a lot of Fed watching. The release of the Fed minutes yesterday, we saw the markets up, and we actually saw the market sell off at the release of the minutes and then rallied toward the end of the session. I think that's contributing to today's futures market opening down. Um, I believe it's just a lot of concern about where inflation is going to be and how tight and how hawkish the Federal Reserve is going to continue to be. I believe in the release of the minutes, they gave away some, in our opinion, they gave away some really key indicators about their strategy for the rest of the year, hinting at needing to raise rates above 5%. So I think the market was a little bit early at thinking that the Fed was going to pause earlier than later. And there's a little bit of scare in the market at this point in time and additional volatility because of that.
Yeah, investors definitely, at least a little bit spooked. In the Fed minutes, we saw a commitment to higher rates for quote unquote some time. Does that change your strategy when it comes to bonds and equities?
We've been in that camp. We've thought that the market was a little bit premature in pricing, the Fed slowing down. We do believe that there's a couple of factors that are at play right now. One is certainly the excess reserves that at one time peaked at $5 trillion. The second is how the price of oil affects inflation. And so the Biden administration came out and used our nation's reserves to try to help cut some of the costs and provide some relief to consumers. But now they're in a position where they're going to have to reposition themselves and purchase. And so I think there's going to be a net increase in inflation based on energy costs as well. The real key right now, though, is that employment and wage prices are still sticky and high, and the Fed actually spoke about that. And as long as wage remains higher than where the rates are, I think the Fed will continue to tighten.
All right, so you mentioned inflation. We've seen oil prices actually drop during the new year. We've also seen the dollar pressure ease a bit since the start of the fourth quarter. The dollar pressure's eased about 6-7% since then. So I know you're a big fan of companies that are actually benefiting from a weaker dollar in the reopening of China. With the news we're getting out of China with rising COVID cases, can you give us a sense of what sectors you're bullish on and what kind of companies that you would tell your clients to invest in?
So the economic data tells us that the areas that their opportunities right now are actually in the service area as well as consumer staples. So we like the opening idea, the global markets opening a little bit more. We also like to see somewhat the pullback in the dollar after a really, really strong dollar for quite some time now. And so we think there's some opportunities, relative values compared to some of the domestic companies in the multinational area, primarily in staples, additionally in some commodities, very select commodities, because we are forecasting slowdown. We're not forecasting recession at this point in time.